What's up, guys? Welcome back to the channel. Today marks a huge milestone in our investment journey, the last module of this level. Let's go. We're diving deep into the world of equity funds, the rock stars of the investment world. But hold on, before you think equity funds. Sounds complicated, trust me, it's not. Let's understand the different types of equity funds. Picture this. You want to build a solid portfolio, right? Equity mutual funds are like your all-star team, investing in a diversified portfolio of stocks targeting long-term capital appreciation. This isn't about quick flips, it's about building wealth over time. So, whether you're just starting or looking to level up, stick around because in this video we're breaking down 9 types of equity funds that can help you reach your financial goals. Let's do this. Alright, let's kick things off with the first type of equity fund. Market cap-based funds. Now, you might be wondering, market cap? Sounds like something out of a sci-fi movie. But chill, it's simpler than you think. Imagine the stock market as a massive playground with companies of all sizes. Market cap, or market capitalization, basically refers to the total value of a company's outstanding shares. So, in this playground, we've got the big leagues, the large cap funds that invest in the top 100 companies by market size. These are like the established giants, think Reliance, HDFC Bank, the blue chip companies. Then we've got the mid-cap funds. These guys invest in the next 150 companies that are still growing and have the potential to become the next big thing. And finally, we have the small cap funds, the risk takers, who invest in companies outside the top 250. These are the startups, the disruptors, the ones with massive growth potential but also higher risk. Now, let's talk about sectoral and thematic funds. These funds are like specialized players in the investment game. They go all in, investing more than 80% of their corpus in a particular sector or theme. Think of it like this. You're super bullish on India's digital revolution, right? So you might consider a technology sector fund. Or maybe you believe in the long-term growth story of India's consumption. In that case, an FMCG sector fund could be your jam. The point is, sectoral and thematic funds allow you to align your investments with specific industries or trends you're passionate about. But remember, with great focus comes great responsibility. These funds can be volatile, so make sure you do your research and understand the risks involved. Now, let's dive into the world of value funds. This is where things get interesting. Value investors are like treasure hunters, always on the lookout for hidden gems in the market. They believe in finding fundamentally strong companies whose stock prices are currently undervalued due to temporary factors or market sentiment. Think of it like finding a diamond in the rough. Value funds require patience, discipline, and a long-term perspective. Remember, Rome wasn't built in a day, and neither are great returns. But if you're willing to ride out the market fluctuations and trust the process, value investing can be incredibly rewarding. Alright guys, if you're feeling adventurous, Contra funds might pique your interest. These funds are like the rebels of the investment world. They go against the grain, following a strategy contrary to the prevailing market sentiment or trends. When everyone's buying, they're selling, and when everyone's selling, they're buying. Contra funds are not for the faint-hearted. They're high-risk, high-reward investments that require a deep understanding of market cycles and a strong stomach for volatility. If you're a seasoned investor looking for unconventional opportunities, Contra funds can be an exciting addition to your portfolio. But remember, always proceed with caution. Now, let's talk about focused funds. These funds are all about, you guessed it, focus. Instead of spreading their investments across hundreds of stocks, focused funds limit their holdings to a maximum of 30 stocks. Think of it like having a laser-sharp focus on a select group of companies that the fund manager believes have the highest growth potential. Now, while this concentrated approach can lead to higher returns, it also comes with moderate risk. So, if you're looking for a fund that can potentially deliver significant returns over a 3 to 5 year horizon, focused funds can be a great option. Let's talk about dividend yield funds. These funds are like the steady earners of the equity world. They focus on investing in companies that have a track record of paying high dividends to their shareholders. Now, dividends are essentially a portion of a company's profits that are distributed among its shareholders. So, with dividend yield funds, you not only have the potential for capital appreciation, but also the benefit of earning regular income from dividends. These funds are a good option for investors looking for a combination of growth and income, especially those nearing retirement or looking for a steady stream of passive income. Now, let's talk about ELSS, or Equity Linked Savings Scheme. This one's a bit special because it offers the dual benefit of tax savings and wealth creation. ELSS funds are a type of equity mutual fund that comes with tax benefits under Section 80C of the Income Tax Act. But we'll dive deeper into the specifics of ELSS in a dedicated video later, so stay tuned for that. Alright guys, let's circle back and break down the market cap categories in a bit more detail. Remember our stock market playground? Large cap funds are like the big players on the block. They invest in the top 100 companies by market size. These are the blue chip companies, the established giants with a proven track record. They offer stability and relatively lower volatility compared to their mid-cap and small-cap counterparts. Mid-cap funds, on the other hand, invest in the next 150 companies. These are companies that are still in their growth phase and have the potential to become the next big thing. They offer higher growth potential than large cap funds, but also come with higher risk. Before we wrap up, a quick disclaimer. Investing in mutual funds involves market risks. Please read all scheme-related documents carefully before investing. To invest in mutual funds, you need to be KYC compliant. Please ensure you complete your KYC process before making any investments. Invest only with SEBI-registered mutual funds. For any investor grievances, you may contact number or email address. So there you have it, guys. We've covered the 9 essential types of equity funds that can help you level up your investment game. Remember, building a solid investment portfolio is a marathon, not a sprint. It's about making informed decisions, staying disciplined, and choosing the right investments that align with your financial goals and risk appetite. Whether you're a seasoned investor or just starting, I hope this video has given you the knowledge and confidence to navigate the exciting world of equity funds.